Okay, let's work this problem. It says to record each of the transactions listed above in the General Ledger tab, review the General Ledger and the trial balance to see the effects of the transactions on the account balances. All right, so let's go to the General Ledger. Let's slide up here so we can read this. Oh, keep sliding on me. So, they're going to give us the transactions here, so this should be pretty straightforward. Provide services to customers for cash for $4,100. All right, I like to do the easy part first. Said we're getting cash. Cash is an asset. It increases with a debit. So I'm going to put 4,100 in here. Okay, we provided services to customer. I'm going to look for some kind of revenue account that says services, probably services revenue, something like that. Keep looking. What do I find? Service revenue. There we go. All right, that's 4,100. All right, I think that's the first journal entry. I think that's what they want us to do. Let's look at number 2. Purchase land with a long-term note for $5,800 from Crimson Company. Well, now we're going to purchase land with a long-term note. So we're not using cash. We are signing a note payable. That's an obligation. But recording the land is probably going to be the easiest. I wonder if I can just type land. Yep, just type land and it comes up. 5,800. Okay, and we know we're going to have a credit for 5,800. What would that be for? Something like note payable. Let's see if I can just type the word payable if it comes up. Well, it's not accounts payable. Accounts payable is used when we're buying things on open account and our vendors or suppliers agree to take our word to pay for it. But it is a note payable. Okay, it's a note payable for 5,800. That looks good. Let's move on to the next transaction. We receive an invoice for $4,400 from the local newspaper for an, I call it an advertisement. Some people would call it an advertisement. I've heard it pronounced both ways. That appeared on September 2nd. Okay, so we received an invoice. We haven't paid it yet, but it was for some kind of advertising. So I'm going to record the advertising expense for $440, and I'm going, again, expenses increase with a debit, and we have to increase the liability, which increases with a credit. And this time, this is from a vendor that provided us with services or goods, in this case, services. And as a result, accounts payable should be the proper account to use. I have to spell it right, though. Okay, 440. All right, and by chance, if I did any of these wrong, we'll check our work and we'll correct it. Provide services to customers on account for 5,400. All right, because it's on account, that means we're now allowing our customers to pay for it in the future. So there's no cash exchanging hands here. Instead, we're going to record that asset as accounts receivable for 5,400. Okay, and we did provide services. Service revenue, 5,400. It's a revenue account. Revenue accounts increase with a credit, so that would be our entry. We can go on to number 5. We purchased supplies on account for 1,100. Again, account means accounts payable. I'll do that one first. All right, our vendors are allowing us to pay $1,100 for supplies at some point in the future. Now, they give us supplies or supplies expense. This can be tricky. I've seen companies use both ways, but to be correct, at the time we purchase it, it has future economic value. So we will record it as an asset as of supplies. Okay, paid $3,400 to Crimson Company for a long-term note. All right, so what does this mean? This means we're paying Crimson Company, we must have had a note with them out. I think this is telling us that we're paying down a note. So I know cash is going to decrease for $3,400. And I think they're telling us we're paying a portion of a note or paying down a long-term note payable. Let me click note. Notes payable. And I might not have this one right. I'm having a hard time interpreting that language. Received $4,400 from customers on account. In this case, we got cash. Cash increases with a debit, $4,400. That means accounts receivable decreased because we're just collecting what was formal, what they already owed us. Okay. We got lots of transactions. Paid $840 for September's rent. Probably that is rent expense or prepaid rent. Again, I'm going to assume we pay for it up front. So it's an asset up front, $840. And we incurred cash. Cash decreases with a credit. Come on in there. $840. Okay. How many more of these do we have? A few more. Paid September's utility bill, $1,700. This could be utility. In this case, since there isn't a prepaid utility, which is very unusual. Normally, there isn't such a concept, but could be. We have utilities expense of $1,700, and we have a cash. Now, the only way this is wrong is if we had already set up the liability and now we're paying it off. Let's look back here. I don't see that liability set up. So I think we're okay. Now we paid employees $3,400 for the month of September. So salaries expense $3,400. Expenses increase with a debit. We're increasing expenses. It says we paid, so we'll assume we're using cash. Since it says pay, $3,400. And the last transaction paid a cash dividend, $1,100 to shareholders. Now we're going to use an account called dividends. Dividends is a contra equity account. Equity accounts normally have a credit balance, but not the dividends. Contra means it goes the opposite way. We increase dividends with a debit. And again, cash is being used. Cash account is used quite a bit in lots of businesses. Okay, now we've done the entry portion of this. We can hit check our work if we wanted to see how we're doing. And the only thing they're objecting to is the prepaid rent, it looks like. So if it's not prepaid rent, then it's rent expense. So go back to prepaid rent. We'll say they're not using a prepayment, we're just paying it off as an expense. Okay, so let's make this rent expense. That way, if you think about it, then you only have to make one payment, one entry a month, record the rent expense. If we charged it to prepaid rent, then we have to make an adjusting entry by the end of the month to correctly state the amount of rent expense and to decrease the prepaid rent. So I understand their logic here. All right, so I think we're done here. We can go on to the next portion. Now, every time we made these entries, it automatically posted for us. So the next thing you have to do is prepare the trial balance. And to prepare the trial balance, you just simply are taking whatever the balances are in the general ledger and carrying it forward. Like here, cash ends 3960. So now we see the 3960. Okay, see how this works? Supplies had a $7,000 balance. Did we touch supplies? Nope, it stayed the same. Accounts receivable, let's look at that, 2,900. Okay, it started at 1,900. We increased it because we made sales on open account, and then some of the customers paid us, so it brought the balance to 2,900. So the whole point of this is it shows you how your entries impact the general ledger, and then how the general ledger provides the balance that you would put on a trial balance. Let's look at accounts payable. It started at 6,900. We had 2 credits to accounts payable. We increased accounts payable twice for various purchases that we made on open account, giving us a balance of 8,440. Okay, so you get a chance to see how all of this flows, and I hope you found this helpful.